Welcome back to the Paper Gains Show. It's just me this week. I think you're really going to enjoy this episode. If you're a business owner with 1 to 10 million to invest, this is the episode for you. We're talking taxes today. The taxes are probably your biggest expense and probably your biggest frustration. Nobody enjoys paying them. So today we're going to walk through some strategies to help you keep more of what you earn. So these are some of the most common silent wealth mistakes that we see business owners make. Starting with poor entity structure, not planning for an exit or future liquidity event, or waiting too late to do proper planning there, failing to leverage retirement plans effectively, overlooking the more advanced tax strategies like qualified small business stock for those that qualify. And then lastly, commingling personal and business expenses in a way that makes it difficult to unwind, or it just makes your future when you do go to sell the company, just makes it harder. Let's dive into each one of those into a little more detail. Starting with entity structure, here's a couple things that we see and that I've seen a lot on social media, and that's staying at a sole prop or a single member LLC for too long, thinking an LLC is a tax election. I see a lot of CPAs on Twitter just reminding people of this. So I'll do the same here. And then S Corps, you see this every so often, but not paying yourself a reasonable compensation and just taking distributions. This just creates red flags. And with all of these, highly recommend to consult a CPA and attorney. If you don't have a good one, Google it, reach out. We can help. We know a lot of great CPAs that do proactive tax planning that a lot of business owners are really looking for. Secondly, not planning for that exit or waiting too long. I would say this is the most common mistake that we see. And generally it starts with not having a clear understanding of what their number is, why it is. Is that number realistic? Is that just because your buddy at the country club sold his manufacturing business for 10 times EBIT that you'll get the same? You could have, while on paper, very similar businesses. Once you dive deeper, wildly different growth or profitability, you name it. And really, I think that starts with understanding your balance sheet and what you're trying to accomplish and what you need, given that most of your net worth, you might be worth 15 million, but currently it's all tied up in the business. You've got a little real estate, okay, and maybe a taxable account, but 10, 12 million of your 15 million net worth is tied up in the value of the business. So figuring out how to navigate that transaction is very much in your benefit. And that really just starts with a very long discussion. So some more tactical things to consider is just potentially doing aggressive tax loss harvesting a couple years before banking those capital losses to help offset future gains, charitable giving, all the normal things that you'd expect. But really it just comes starting to have a conversation, getting a very good understanding of what your goals are. And so if this is you and you're kind of a couple years out, feel free to reach out, and we're happy to give you some guidance and have that conversation. So failure to leverage retirement plans. This is one we see often as well. Most people have a 401k plan, but they might not be utilizing it to the full extent with profit sharing or potentially adding more advanced structures like a defined benefit cash balance plan to it, if that's appropriate and a good fit. All of those require a lot of coordination between your CPA, your financial advisor, and a good understanding of what you're getting into and really what you're trying to accomplish. Going into some of the advanced tax strategies, just again, I am a CFP, but I am not a CPA, so don't just rely on this. This is meant to be educational. Qualified small business stock. This is one we've talked about a few times through blog posts as well as here. But if you qualify, if you're a C Corp, if you've been in that C Corp for an appropriate amount of time, there's a huge tax benefit for those who qualify. And then the last one speaks for itself. The importance of just keeping things separate between your personal and your business life. I know it can be very tempting, and sometimes there is a benefit, especially if you have a lifestyle business. But if you are looking to sell your business in the next few years, I would say it's even more important for somebody like yourself, just because you may think you're extremely profitable, but you've commingled everything with your personal life, and it just becomes harder to unwind, and you just not as attractive of an acquisition target. All this is entity choice matters. Start planning for an exit at least 1, 2, 3, 4 years. The sooner the better that you're having those conversations with a financial advisor, your CPA, your attorney, and getting that foundations. And then you take advantage of those advanced tax planning strategies. So appreciate you tuning in, and please subscribe and give us a follow on the newsletter as well. And see you next week.